All right, let's get right into it. We are staring down the barrel of a week that could truly define the market's next big move. This is going to be a high-stakes showdown, a real test for every single investor out there. And I'm not kidding about the stakes. As one analyst put it, this could be a disastrous trial for the unprepared. See, this isn't just business as usual. This is one of those moments where being ready for what's coming is absolutely everything.
So, to make sure you're prepared, here's how we're going to break it all down. First, we'll look at the data showdown itself. Then, we'll decode the two key triggers. After that, we'll game out 4 possible scenarios for the market. We'll also cover a pro-level volatility play, and we'll wrap it all up with a concrete battle plan for you.
Okay, first up, the come-in data showdown. So what's all the fuss about? Well, Wall Street is calling this a double catalyst trial. And that's because we're getting 2 massive market-moving reports back to back, and you better believe their combined impact could set the tone for months to come. So mark your calendars. On Wednesday, we get the non-farm payrolls report, the big jobs number. Then just 2 days later on Friday, the CPI report drops. And that, of course, is the main event for inflation. 2 reports just 48 hours apart.
Now, let's decode these 2 triggers, because it's not really about the headline numbers that you'll see on TV. No, it's about what one analyst is calling the poison and the bomb that are hidden deep inside the data.
See, each report has its own unique danger. For the NFP jobs report, the poison is something called benchmark revisions. These are basically backward-looking corrections that could suddenly reveal that the strong job market we thought we had, well, it was kind of a lie, and it's actually much weaker. Then you have the bomb in the CPI report. That bomb is the 0.3% month-over-month number. Think of it as the market's last line of defense. If that number comes in any hotter, it could prove that inflation isn't really dead after all, which would be a total nightmare.
So knowing those 2 big risks, we can dive into the heart of this thing. The 4 possible scenarios. Depending on how the NFP's poison and the CPI's bomb play off each other, we could see 4 completely different futures for the market. And this right here, this table, is your roadmap for the week. It's actually pretty simple. On one side, you've got jobs either weak or strong. On the other, you've got inflation either tame or high. And where those 2 intersect gives us our 4 outcomes: the soft landing, the ultimate market killer, what's called the Fed's headache, and, of course, the one everyone's afraid of, the stagflation shadow.
Let's start with the best-case scenario, the one we're all hoping for, the soft landing. This happens if we get a weak jobs report and tame inflation. It's the perfect combo. It's a green light for the Fed to start cutting rates, and you'd expect to see risk assets, especially the beaten-down stuff like biotech and regional banks, just rally like crazy. Okay, now for a weird one. Scenario 3, the Fed's headache. This is where things get really messy. You get a strong jobs report, which is great for the economy, right? But you also get tame inflation, which means the Fed should be cutting rates. So, good news is bad news? Bad news is good news? The market would be completely torn, and you'd see these wild, directionless swings, what the source called crazy rises and sharp falls, as nobody can agree on what to do. Scenario 2 is, well, it's just plain painful. They're calling it the ultimate market killer. This is what you get with a strong jobs report and high inflation. This is the combo that forces the Fed's hand, keeps them aggressive. It's not quite stagflation, but it's a massacre, where the dollar would soar, stocks would get absolutely crushed, and bond yields would spike higher. Just ugly all around.
But believe it or not, that's not even the worst of it. The true nightmare is scenario 4. This is what happens if we get a weak jobs report and stubbornly high inflation. The worst of both worlds. The economy is slowing down, but prices are still ripping higher. This is when the stagflation shadow finally makes an appearance.
And if that nightmare scenario actually happens, this is the only number that will matter: 6,720 on the S&P 500. According to this analysis, that critical support level would just evaporate. It is the absolute line in the sand for this bull market.
Okay, so that's a lot to worry about. But let's switch gears and talk about how the pros actually navigate this stuff. Because there's a really interesting kind of counterintuitive truth about how market fear really works that they use to their advantage.
The whole concept is called a volatility crush. And it's based on this tendency for the VIX, the market's fear index, to actually fall, to get crushed right after a big report comes out. But why? Well, it's because the market hates uncertainty more than anything else. Once the data is out there, whether it's good or bad, the uncertainty is gone. It's replaced by clarity, and fear, surprisingly, goes down.
And hey, don't just take my word for it. The data backs this up big time. If you look back historically, on the day the NFP report comes out, the VIX closes lower a staggering 70% of the time. The market just wants the information, even if it's bad news.
And it's the same story for the other report. Since 2021, the median drop in the VIX on CPI day has been 4.3%. That's a pretty big deal. So the big takeaway here is that betting on fear to keep rising after the news is already out is usually a losing bet.
Which brings us to our final and maybe most important section, your battle plan. We've gone over the risks, we've laid out the scenarios, so now let's talk about a clear framework for what to do before the data and what to do after.
First things first, before any numbers come out, it's all about risk management, playing defense. This might mean reducing your overall position size just to lower your exposure to any wild swings. It could also mean hedging with something like gold, or maybe even looking at Treasury inflation-protected securities, or TIPS, which are designed to do well when inflation is a problem. Okay, then the moment of truth comes. The data is released. What do? Remember this simple three-step process. Number 1, wait. Just wait. The first 15 to 30 minutes is just pure computer-driven chaos. Ignore it. Step 2, observe. Watch the big, liquid markets like the S&P 500. See where the real money is flowing. And finally, step 3, follow. Wait for the big institutions to show their hand and establish a real trend. And only then do you follow that move.
And that brings us to the final non-negotiable rule. Remember that number we talked about, 6,720? That is your ultimate line in the sand. If the S&P 500 breaks below that level, the advice from the analysis is blunt and brutal. Get out. No mercy. That's the signal that the game has changed, and it's time to protect your capital, period.
So there you have it. The battle lines are drawn, the scenarios are on the table, and the massive question we're all facing is, will this week deliver that perfect soft landing everyone's been dreaming of? Or is the stagflation shadow that we've all been dreading about to finally fall?